silver's now $84.63, up about 25% since that bottom on 6th of February. And it's up around 15% since the start of the year. Now that rise in the silver price tells us quite clearly that the shorts are feeling the most pain from the rise in silver. Now, why are the shorts under pressure? The answer is simple, and I'm going to show you this in a second. The silver is simply not there. The amount of registered, in other words, deliverable silver held in the CME warehouses is currently 88 million ounces. So I repeat that, only 88 million ounces are in CME warehouses. Yet the March open interest is the equivalent of 239 million ounces, nearly 3 times as much as the available supply. Now that number will change, and it will change downwards, but unless it goes below 80 million, there's going to be a problem, because that's all that's there at the moment, 88 million ounces. Now, nobody knows how many of those longs intend to close their position before the first delivery date. And that uncertainty is the shorts problem. And it might explain why the silver price has been rising recently. If too many longs stand for delivery, in other words, they do nothing, the shorts will be squeezed, and the silver price could explode upwards. If a significant number of the March contracts remain open after the first delivery day, the 2nd of March, we could see an explosive upwards movement in the silver price during March. Now let's look at the silver inventory and see how much is there. And we'll look at this chart here. What we're looking at here is the number of registered deliverable silver ounces held in CME warehouses. And the chart goes all the way back to October, when there was around 170 million ounces of silver in CME warehouses. 170 million, today it's around 88 million. So it's gone down from 170 million to around 88 million. And there's good reasons to think that this March will be at least as high as it was a year ago, of 80 million ounces. In fact, it could be much higher. So given that there won't be more than 80 million ounces, by the looks of things, in the CME on the first delivery date, the 2nd of March 2026, what's going to happen by the time we get to May? There's the big question. So let's have a look at the situation now. I'm going to look at the with the open interest. I'm looking at the same chart now. That's coming up. There we are. This is the same chart as before with the registered deliverable silver held in the CME warehouses, but I've expanded the scale to include this green line going down, which shows the open interest for March silver. Now you can see the lines falling. That's perfectly normal. There are currently 47,847 March contracts open, which represent 239 million ounces of silver. That's nearly 3 times the registered inventory of around 88 million, or what will by that date probably be 80 million. Now, open interest always falls sharply as the first notice date approaches. That's completely normal. The interest, or the question we've got, is how far it will fall. Based on the current trend, which is the pink dashed line here, around 125 million ounces could still be outstanding for delivery on the first delivery date, March the 2nd, which would be significantly more than the projected 80 million, which might be held at that date, and significantly more than the 80 million which were actually delivered in March 2025. So if the scenario plays out as per the trend line, which looks likely, the naked shorts will have to be frantically buying back their contracts to reduce the open interest, which will be driving the silver price sharply higher. So the worst case for the shorts, and this is an unlikely event, but I'm going to tell you what it will be. In the unlikely event that the open interest barely falls, the shorts would face a catastrophic squeeze. They would need to source silver far beyond what's available, or more likely, they'd have to keep bidding up the price until the longs are willing to sell. Either way, it looks like the silver price moves explosively higher. So let's see what's been happening to silver. Here's the chart of silver. Silver closed on Friday at $84.63. Now that's well below the peak here at the end of January. That was a peak of $121.67 right at the end of January. But it's also significantly above the low, which was $64.08. And that low occurred on 6th of February, the last time the margin was increased. So silver has risen about 25% from the low point to this $84.63. And that it's risen 25% in what, maximum, about 11 days. Yeah, 11 days, less than 2 weeks. So this rise in price is telling me, and it's a strong signal, that the shorts are under pressure to close their positions because they're not sure they're going to be able to lay their hands on silver to deliver at the end of March, or on or before the end of March. Of course, many of the shorts will have silver and they'll just be delivering it and getting the cash, and they're the ones who are likely to deliver on the earliest date, the day 1, 2nd of March. But those who haven't got the silver will be hoping that the price goes down, or thinking that they can get it from some other source, perhaps by an inwards delivery from a miner or somewhere like, or a smelter. The first key date is Thursday, 26th of February. This is known as the first position date. And this is the last day for the longs who do not wish to take physical delivery to close or roll over their March contracts. From this date onwards, clearing firms require that any remaining long positions are only held by parties with both the cash and the infrastructure to accept delivery. So basically, speculators and any fund which doesn't want the physical silver has to be out by that date. They must be out by that date, or they're going to have the cash ready to go at any point during the month of March. The next date is Friday the 27th, after the first position date. So Friday 27th is called the first notice day. That's this Friday coming in 5 days' time. This is the first day that a short can formally notify the exchange of their intention to deliver physical silver. So if a short notifies the exchange on that date, the exchange then assigns that notice to one of the longs. Can be any long. So if you're long on that date, you might get assigned, you might not get assigned, but a lot of the shorts will give the notice on that date for assigning their silver if they've got it. So it's the short, not the long, who initiates the delivery. The long can't say, I'd like delivery tomorrow or next week or next month. The long can't say anything. It's the short who decides when to issue the notice, and as soon as the notice is issued, the next day the silver is going to be delivered. So any long who is still open on February the 27th, the first notice day, or rather, if he's long the day before, the previous day, the 26th, and hasn't closed his position, he will simply receive whatever notice the exchange assigns to him, and he have no say in the timing. And once the long receives the delivery notice, he can't exit. He has to take and pay for the physical metal. That's why any long who does not want the metal must be out of the market before this date. And therefore, by implication, any long who does want the metal will still be in the market on that date. And we can judge how many longs are involved there by looking at how much the open interest is on that date. Neither the longs nor the shorts need to put up the full value of the contract. So today the full value of the contract would be about $420,000 per contract. They only have to post a tiny fraction of that value, which is called the margin. They post it as a good faith deposit. So both longs and shorts must put up margin. The margin is actually a very powerful tool for COMEX, for the CME, to reduce the risk of a delivery squeeze. So all they have to do to force out investors from the contract to reduce the open interest is to raise the margin. And the reason people will be forced out of the contract when they raise the margin is some just don't have the cash to put up the extra margin, so they sell their contract or close it. And some have better things to do with their cash, so they don't want to pay the margin, so they close their contract as well. So it doesn't matter whether you're a short or a long, you might have something better to do with your cash when they raise the margin on you, and you say, well, I'm out of here, I'll use my cash for something else. Or you might not have the cash, in which case you have to close your contract. So let's talk about how the margin has evolved over recent months. Back in October, the margin was $22,000 per contract. Then, in October, they raised it to $30,000 per contract. In January, they raised it not to a fixed amount, but to 9% of the contract value. That was on January the 13th. On January the 27th, they raised it to 11% of the contract value. Now, don't forget the value of silver was rising at the time, so that was more than a rise from 9% to 11% in money terms. It was quite a big rise. On January the 31st, they raised it from 11% to 15% of the total value of the contract. And on February the 6th, they raised it to 18% of the value of the contract. So the maintenance margin now, which is very roughly 18%, it's 17.5%, something like that, is $74,109 per contract, which is well over double, nearly triple what it was a few months ago. By tying up more cash, the CME is encouraging both longs and shorts to close their positions. Fewer open contracts means there's less of a delivery crunch coming in March. So what do we need to watch? What's going to happen? Well, there's many moving parts, and a great deal could change in the next 5 days. The amount of registered silver might go up or down. The trend is down at the moment. The level of demand for delivery might be higher or lower than last year. Currently, it's looking like it'll be higher. The CME could raise margins again, forcing people out of the market. They've raised it multiple times in the last few months. It's entirely possible they might decide to raise margins during the course of this coming week. We simply don't know. What we do know is this. The numbers we can see today are pointing to a potential shortage.